Here and let us get started. So again, thanks again. I love these kind of Saturday events. We can have the markets close, no distractions, kind of kick back, and then we've got another exciting earnings season coming up starting next week. We got the banks kicking off. So that's what we're going to be touching on today, how to capitalize on earnings season uncertainty and volatility. And I'm going to go through some, really great option strategies that, you can look to incorporate, to trade earnings season, so you don't have to sit on the sidelines if that's something that you're interested in. So let us get started. So, earnings, are just a really crazy time of the year, as we know, because there's always that unsettling confusion. But before I kick off on the earnings side, just a little background on myself. I've been actively trading the markets now for over 40 years. Started my journey back in the 80s on the oil side with a company called Coastal Corporation, who had actually had a training program to teach you how to trade cargoes of crude oil or pipeline oil or products. And so it was a big refining group. We had refiners, or Coastal had refiners all over the world. So got accepted into the program, which was a great opportunity. Sent me down to one of the refineries down in Corpus, Texas. Spent about 2.5, 3 months down there. It's just a really great experience to kind of learn the fundamentals of crude, bringing in, the crude ships and bringing in the oil, process it through the refinery, kind of learn the whole fundamentals of it, from that, to see it from the ground up. And then eventually got into the tanker side, operations, chartering tankers and stuff. That was really pretty cool. I really enjoyed that. And then finally got into the crude group, trading cargoes of crude. Sent me out to Singapore for a couple of years, traded products out there in crude. And then back in about the mid 80s, got a job at a company called not Coastal, but Transworld Oil. At that time, they were the largest oil trading company in the world. It was Transworld, Fibra, Mark Rich. And so that's really where the excitement started, man. It was we were just trading everything. And so I spent about 17 years there, about 15 of those years out in Bermuda. That was where our corporate office was, and that was a great place to be. Ran the international trading desk for 10 years out of Bermuda. But that's where I started trading options back in 1987 on cargoes of crude oil, and just kind of never looked back. So options are the way to go. And today we're going to talk about, the various different option strategies that you can incorporate to take, opportunities that exist when we have these earnings season type trades coming up. So that being said, let us get started. So the following workshop presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice, should not be construed as a recommendation. So first off, have you kind of noticed how earnings can be horrendous and the stock goes up, or earnings are off the wall chart, fantastic, they look great and the stock tanks? So this is what I call that earnings confusion. It can get really frustrating, during an earnings season because of this confusion. Now, when a company has an earnings conference call scheduled to announce their earnings, many times there's going to be speculation not only into the accuracy of the projected earnings or earnings per share, the revenues, things like that, but there are also going to be potentially other factors and things that they might, announce during that earnings call that might surprise the market. So it's this kind of uncertainty that causes an increase in the volatility of the shares of the specific company, and that's becomes the big diamond in the rough. So it's this temporary parabolic rise in the volatility that is going to spike option prices higher. So basically what happens, traders are going to tend to stay on the sidelines going into the days leading up to an earnings conference call. And then all of a sudden you're going to see, a lot of times you'll start seeing call buyers coming in, swapping out the shares of their long stock, to kind of reduce their risk, but wanting to stay within the potential for it to go up. And so they swap into shares or swap into call options so they can participate in the potential rise in the shares higher, but they want to limit the potential loss should the shares go lower. So you see all this additional surge in demand. And then additionally, you're going to see put buyers coming in, forcing those options higher as they try to protect their positions from any major downside movement. So it's all this concentrated option buying in many cases that will really, expand the volatility levels of stocks being traded into their earnings release. So as an individual trader, you can take advantage of all this uncertainty and volatility in order to capture the profits. But it's just a matter of just understanding, what the strategies are available to you, how to use them, and set the trades up so you can take advantage of these, crazy earnings reactions that come out. Now, step one is you want to identify and qualify a particular stock. You want to look at its past earnings performance, its history, and the probabilities of it heading into an earnings release. So I like to look at certain consistent patterns of specific stocks. Sometimes you'll have a group of stocks that have huge moves after an earnings release, or other times you'll have stocks that don't move at all. So I like to kind of find that consistency or patterns of these specific individual stocks. So we want to look at those stocks, that have also earnings released during an earnings option expiration series. We want to take advantage of using weeklies because of the higher implied volatility that spikes the premiums, and also at times we can get cheaper options to buy if we want to play a price spike. Now, step two is we want to evaluate past performance. We want to see what has volatility done previously to a stock as it moves closer to its earnings release, and even after the release of its earnings. Does it have any kind of post-earnings move that's consistent? Now, then as a prepared trader, we can look for the kind of dramatic increases in a stock's volatility as it approaches its earnings release. Now, a stock volatility normally, will be around 25 to 40%, but the week of an earnings release, its volatility can easily move to extremes, going into that release date because of all the uncertainty. So this is what, can make a stock a potentially great profit opportunity. It's that volatility that can normally double, and in some cases even be more extreme than that. So this is what we want to look for, and this is the potential opportunities that you're going to be able to get. So here's just kind of an example. So here's NVIDIA, and look at this example back when it was trading at $270. That's amazing, huh? So, on the 13th of February, so on a Thursday, they were going to have their earnings release after the close. And so one day at expiration, so the next day, the 14th, was going to be the expiration date. So it was trading going into the earnings on the 13th at $270. Now you can see here the implied volatility. So right here, this series here, this is the 14 Feb series, one day at expiration, and you can see the implied volatility of this series is over 114%. Now you can look behind it, you can see, the normal volatility for NVIDIA was, around 40%. So you can see, it's doubled, it's almost tripled, right here, or over triple as far as the implied volatility moving up. So normally it's around 40, now it's 114. And that's going in just one day to expiration. So that's all the uncertainty that's building up. So the market's saying it could go potentially, theoretically, it could go up $17 or it could go down $17 the next day. And that would just be a one standard deviation move. But as we see in earnings, a lot of times we can have greater moves than one standard deviation. It could be two or sometimes even greater than that. So here's kind of the normal move would be here up 17 or down 17 one day later. All right, so that would be the normal implied move. All right, so but sometimes can be a lot greater, but that's what we can potentially take advantage of to, if you're looking to sell the implied volatility when it spikes higher, or sometimes we might even want to play the price spike. So I'm going to show you some different strategies that you can use to kind of take advantage of this high implied volatility or the potential big spikes. All right, so that's it going into the earnings release. And then you can see the day after the earnings release, you can see that volatility is crushed, it's collapsed. And so it's gone kind of back to normal. So it went from 114 the day before, now it collapsed back down to kind of the normal implied volatility down to 35. And the price though also spiked. You can see this price now was up 7.5% up to 291. So you have these kind of different things that can happen. You can have the big price spikes, you can have the implied volatility collapse. So you have a number of different ways to take advantage of an earnings trade going into its earnings and then even after. All right, so you can see here on the chart, here it was trading right there going in at about 270. The implied volatility, you can see below, this kind of graph below shows you how that implied volatility kept moving higher and higher as it approached earnings and then collapses after that uncertainty is taken out. It's like popping a balloon. So it's trading right here going in, price spike up, 7.5%, implied volatility collapse. So a couple things, to way to play that trade. And so that's what we'll talk about here in a couple minutes. But that's kind of, what you're going to see in a lot of these different individual stocks. So it's for this reason, it's essential that you have a watch list of stocks that you can monitor closely due to the fact that, they're not going to all present an equal trading opportunity for an earnings trade. So remember, the goal is to take advantage of the temporary rise in volatility as well as past earnings performance and the probabilities, of, what potential probabilities of the trade might exist or have going forward as far as, big moves up or kind of volatility collapse. So we want to look at probabilities, and that's what is very important to select the right trades. So there are kind of 3 earnings cycle trades that you can also look for. So first one is kind of the trend trade into the earnings release. So this is when, it's trending up, the implied volatility starts moving up each and every day because of the uncertainty building in. And then you have the kind of second trade is the earnings release trade. So this is kind of a non-directional where you don't have any ideas. Is it going to go up? Is it going to go down? So there's a kind of a trade setup you can do for that. And then the third one is a trend trade, a post-earnings trade that you can do. So a lot of times, after the earnings release, the stock will, tend to trade either up or down, that post-earnings trend. So some stocks kind of have consistency to do that. So that's another thing we want to try to find and identify. So here's just a kind of a good example of the 3 potential types setups. So here's trade 1. This was on CRM. And you can see it was trending into earnings and the volatility was trending higher. So you can see CRM here, you can just see the price was trending up, right? And also at the same time, you can see the implied volatility down here, this teal color, it was steadily increasing as well, okay? So the implied volatility is going up, but also the stock price was going up. So a lot of times we're gonna see stocks move or increase into the earnings because the market thinking, okay, they're gonna have good earnings, I wanna get in ahead of time and play it to the upside. And then the other thing to remember is that when implied volatility goes up, that increases the price of your options, right? So the 2 things that increase option price is the implied volatility. Okay, so when that goes up, that's increasing your premium or your option price. And also, the delta, when that's going up, that increases the price too. So, if you're, going into a pre-earnings kind of trend trade up, you want to buy, calls or something or puts if you think it's going to trend up, calls in the week of the expiration and work those for the trend up, taking advantage of the implied volatility moving up, pushing that price up, and, the potential of the price moving up itself. So we can do that. That's kind of trade 1 to take advantage of that. But you want to be, if you're going to do that trade, you always, in my opinion, you want to be out. That's a specific trade, and you want to be out before the earnings release, because then you have no idea. It could collapse, it could go up. Well, the volatility always collapses, but the price could spike up or down. So you want to just be out of that pre-earnings trade 1, and then you can get set up for a different trade. Trade 2 is your trade for the non-directional earnings release trade. So this could be selling the volatility, or this could be playing for a price spike. But one thing that always happens is that implied volatility collapses. See that? So it goes up, going into the earnings release, all the uncertainty after the release, after the announcement, all that uncertainty is taken out, that volatility collapses. So, we can take advantage of that with certain strategies. All right. And then the third trade is your post-earnings trend trade. So a lot of times, you'll see a specific stock have the kind of remain in a trend. So you can see here, this was CRM was trending up. Then it had its earnings release, came down, found support, and then trended back up, kind of in the direction of the the earnings. So it kept trending. So you've got that post-earnings trend. So that's kind of the trade 3 that you can take advantage of. So a couple different ways we'll take advantage of that. We'll talk about one that I like to look at is what we can use a pairs trade to trade an earnings post-trend trade up, or some other type of strategies that we can use. But those are kind of the 3 trades that you can be kind of looking for to identify. Now, here's another example. Here was like Nike. You can see it was on the price of Nike, it was trending up, or here actually in this example, it was trending down, but implied volatility was trending up, and then it collapsed. And then here was another one. You can see that, here was Nike also trending down, price trending down, but look at the implied volatility is trending up. Then price, then the earnings were released here. It actually had a big price spike up, implied volatility collapses down. All right, so you can see, how that implied volatility, works typically, just by these two examples here. Now, step 3 is we want to use kind of what I call pre-earnings checklist. We want to try to systematize the trade setup process, which is important for making your best trading selection on a trade. So I always like to make things, for trading as systematic and mechanical as you can to kind of take out your emotions of your trade and just kind of have a certain process you repeat over and over to make it less emotional for your trades that you're setting up. So the things that we're looking for, high earnings probability stock checklist. So first off, the stock that you're looking at must have options and have good option liquidity. Also must have a pre-earnings volatility that, has a tendency to, kind of increase in volatility, which is always going to be the case actually. So the other thing I like to do is look for, over kind of I have a screen, I look for past price moves that on average were either greater than 5% up or down or less than 7%. So what I'm looking for is to kind of identify and kind of categorize, kind of put a bucket together of different potential type of trades that we look for. So there's kind of one bucket, that would be stocks that have a tendency to have big explosive moves up or down of, greater than 5%. All right, so there's this one group there. So there are a lot of different stocks that can have these kind of potentially, huge moves like NVIDIA, Netflix, Tesla, things like that. They tend to have big price spikes a lot of times. And kind of another bucket that I like to look at would be, a max move of say, max move of 7%. That's the greatest, it would go up a tendency over, many years, like 2 to 3, 4, 5 years. There are certain stocks that don't move much. Maybe they'll go up 5% or 7%, but that's about it. They tend to have that kind of cap. So with these types of stocks, we can then look at those for, trading volatility collapse, to take advantage of that high implied volatility. So there are a couple of different strategies that I like to use to take advantage of that. So kind of these buckets are, what you want to put together for your watch list and kind of categorize the trades. So the next thing you want to do is we want to calculate the implied move of your stock the day of its earnings announcement. So by doing this, we can then set up our earnings price targets, using that kind of target analysis of the volatility and the straddle price and straddle cost, things like that. We can then, kind of plan out where this price could go up or down after the release. And then we can set our trade up based on those price targets. Then once we have that, we can then set up the appropriate weekly option strategy to use, have our entry plan, determine what exit plan to use, and then we're kind of prepared for the trade. So these are kind of the steps involved in each and every trade. So here's kind of one thing that, kind of some data analysis kind of steps. So here's like Roku. And Roku's one that has tendency in the past to have pretty big price moves up or down. So here's Roku, on the 7th of May, and it's going to have its earnings release. That would be like on a Thursday, and the expiration's the next day. So you can see the expected move going into this earnings release was for a move 11%, 11.64% expected move up or down over just 1 day period. So that's potential for a huge potential price spike, right? So you can see the implied volatility here is over 200% here. And normal volatility is pretty high price volatility stock, but you can see this is well over kind of the norm, which is about anywhere from 70% or so like that. You're up to 200. So it's just saying 1 day, the expected move could be, this thing could go up just a normal 1 standard deviation move. This thing could be up $16 up or down within that 1 day period. Looking at kind of the normal distribution curve here, it could be up 16 or it could be down 16 That's what the market theoretically is projecting for Roku 1 day later. And as we see with earnings, though, it could be a lot greater. It could be almost 2 standard deviations, or even in more extreme than that. All right, so that's what we want to be aware of, take advantage of, in a number of different ways we can do that. So that's, kind of look there, and then you can see the day after. Here again, volatility collapse, just like that NVIDIA example. You can see it collapse back down to kind of the normal volatility of 70, 73%. But it also, you can see the day it was trading at 137.50, and the next day it was trading at 127.65. So it collapsed down on price as well. It was down 7% to the downside, also with the volatility collapse. So that's the things that we can take advantage of with certain strategies. So then what I like to do is I can look at the data and kind of get an idea of what a specific stock tends to do, in the past based on its past performance. So here's some earnings statistics that I like to use. And you can see here on this example, you can see Roku was trading at going into its earnings with 165.42. So here's the implied expected move history. So it tends to have big moves, 10% up, 11% up or down, 14, 14, 14. So this is a big move at Roku. So you can just see from that history there. Now, when we look down, we just break it down. What did it actually do the day after the earnings release at expiration? So you can see here, this is what I really like to look for. So you can see that Roku here traded down the day after its expiration. It was down almost 7%. The earnings series or history cycle before that was down almost 8%, 6% down, 16% down, 20% up, 28% up, 25. So this has the tendency for some big, huge moves, either up or down. And so that puts that into a certain bucket list, right? That would put this in that bucket list of, plus, or minus greater than 5%. So this has a tendency to move either greater than 5% up or greater than 5% down. So big price spike potential moves. So that tells me, what potentially to do and what not to do as far as an earnings trade on something like Roku based on this history. So then you just kind of put it down into kind of price data table here, just to kind of see it even more clearly. You can see here, this is going back over 8 cycles, and you can see the earnings price going into the earnings release here. You can see how high it was. But here's the really important stuff. So here's the implied move history. So here it was, over those 8 cycles, you can see it has an average of about 14.5% implied expected move over 8 cycles. So we can go back and look at the earnings history. I've got some data that does that for any stock that we want to kind of analyze. And then what I really like to look at, what did it actually do at expiration? So here was a 1-day expiration. So this came out on Thursday, and then it expires on a Friday. So you can see, though, it actually had, when you look down at the average, it actually had a bigger moves than the expected implied move. So this tells you, okay, well, this would be probably a good one to just play a potential big price spike up or down, because it has a tendency to have these large moves, even greater than the implied expected move that the market's looking for. So you can see here over the 8 cycles, the lowest move was actually like a 6% move up. So if you were to do, an earnings trade setting something up for, a 6% move up or down, this would have been a winning trade. 5% up or 6% up, you can see this would be a winning trade because it has big price spikes up. Right, so that's that tells you, okay, there's a certain strategy that then we could use for something like a Roku if we wanted to play it for an earnings opportunity type trade. So it really comes down to the trade selection, very important. So step 4 is that the power of the weekly options. So I like to use weekly options on these kind of earnings trades to take advantage of the 2 really big pricing components that make up a good option price. So that's going to be your time value component and the implied volatility. So those are the 2 key option pricing components. So it's the combination of these 2, pricing components, when used correctly, can help you to create low cost defined risk trading kind of a formula or plan for generating high returns in a very short period of time. So kind of like lightning in a bottle. So just for example, you look back at Roku, it has that tendency for big price spikes. So this thing can move quick in one day, which is, if you get it right, it's kind of like capturing lightning in a bottle on a specific trade like that. Now, if you know then which weekly option strategy to use for the earnings trade, how to construct the trade, and then when to put the trade on using the weeklies, this can really produce some exceptional fast profits due to the incredible leverage that they provide, making them the perfect kind of trading vehicle for your earnings trade. So how's this done? So what I like to do is what I call kind of comparative option strategy analysis. So there are a number of different strategies that we can use, we'll go through. So what I like to do though is then when you're constructing or looking for the earnings trade to set up, you want to look then at the risk to reward or the return on your capital that you're putting up at risk between the various option strategies you're looking to use, and then compare and select the best risk reward set up for your trading goals. So there are going to be times then also that you can use more than one strategy for the same stock. You could do two different strategies, but this will then give you an idea of which one might fit your risk profile of what you're looking for. So we're going to go through the different strategies that you can look to use. So then the next thing is, okay, what are the strategies and how do they work? So there are kind of basically 5 different strategies that you can use to capture profits from the extreme price volatility that surrounds every earnings season. And each strategy works best on certain circumstances, certain parameters of what they present to you based on their prior history. So the different strategies that I like to use and we'll look at and we'll go through today is number one is what we call a short iron condor spread. So this is actually a debit spread, and this option spread strategy is constructed to take advantage of big explosive price spikes up or down, like the Nvidia or the Roku or something like that, or Netflix. Sometimes you have these big moves up or down that just explode 4 or 5, not 4 or 5, but 6 or 7 or 8% or 10% or 12%, after the earnings release. So this is one way to take advantage of the spikes. Now the second strategy is a really good one too. This is what's called the iron condor credit spread. So this is constructed for volatility collapse or crush. So as you saw in the slides earlier, as we're going into an earnings release, that implied volatility goes up, right? And a lot of times it's very extreme. So we could actually set up a trade to take advantage of when it collapses back down to the normal volatility. And this is one strategy that we can use for that. Now the next one is what we call the iron butterfly. So this is a kind of similar strategy to use for volatility crush. All right, so this is actually a butterfly that you can do selling at the money, call and put butterfly to set up to take advantage of volatility collapse. Now the fourth one is what I call the double lightning. So this is kind of a really flexible trade strategy we can use, and it's basically a debit spread. But the thing that's good about this one, we can take advantage of both volatility crush and any post-earnings trend. All right, so this makes this a very unique trading strategy to use for an earnings trade. And then the fifth one that we'll talk about is the earnings pairs trading strategy. So this is a kind of a long short trade strategy that you can use for trading a post-earnings trend. This kind of give you kind of a delta neutral based on a pairs trade, but we can then set it up with the earnings being the catalyst. A lot of times can really make a pairs trade work great because it separates. You could get big, huge separation from a certain stock that you have paired with something that's closely correlated to it, within maybe an ETF sector or something like that. So we're going to go through these different strategies that you can incorporate to take advantage of these different types of things that happen, during earnings. Now, before I get into this, to make sure everybody might be taking off early today with the summertime and all that stuff, but next Saturday I'm going to be doing a concentrated workshop on earnings trades. So it'll be next Saturday, starting July the 13th, from 11 to 2 p.m. Eastern, or however long we need. Then we'll follow up and finish up on Monday the 15th from 4 to 5 p.m. And I've got a special price for everybody here today. If you'd like to jump into this offer. We've got, if you use a EARN small cap 15, you're going to get an extra 15% off. So use this link here, and I'll go through it kind of briefly here, then we'll continue on, and then we'll come back to it more towards the end and answer questions. But for right now, if you want to sign up, the course price is going to be $197. But if you use this EARN 15 small cap, use that in the promo code when you go in here, you'll get a 15% off discount. So it's $167 for this course. So that's a 93% discount off the course package. Now you're going to get a bunch of extra stuff in the course package, some really nice bonuses. So the whole course package value is over $2,400. But if you use this EARN 15 today, you're going to get this whole thing for $167. And then course package 2 is if you want to also include it using have access to my alert service for the next 4 months and the trading club and all the live course, all bonuses. It's $597. But if you use this promo code EARN 15 small cap, you'll get this off at $507. So all you have to do here is pretty simple. Just click the link here or copy and paste it. So it's powercycletrading.com/special. Okay, and you're going to get this drop down will pop up, and here it is. So capitalize on earnings season uncertainty. So this will be the where you can sign up here today, and you've got this promo code EARN 15. You're going to get 15% off. So course package 1, if you're looking, this will be just the live course and all the bonuses. You can see all the good stuff that you're going to get. You're going to get, going through this briefly, you'll get the earnings course, the workshop, 4+ hour live earnings workshop. This will all be recorded, broken down in modules, but it's live, when I go through it initially on next Saturday, but then you'll get the recording, the PowerPoint of everything. And then to start off, you're going to get bonus 1. You're going to get my on-demand course that I've already done, so you can get started right away. My earnings option course, you'll get that right away. And then you'll get bonus 2, start trading options today. So it's a really good kind of intermediate option course that you can get started with on credit spreads or debit spreads, things like that. So the value, these are values on my website, $197. And then you're going to get a 30-day trial membership to my trading club. So it's $97 if you stay on after that. I've got other different, packages that you can do on, different trading club, packages if you want to do a year, or you could do, the alert service, you could shift into that if you wanted. And then we'll do a follow-up Q&A, okay? And then we're going to give you my Greek strategy guide, how the Greeks are used. So this is another little option course here on the Greeks. And then you're going to get my 3 trade lists, the best stocks for earnings. So this is 3 different scans I do, and you'll get that. So you can see the course bonus values there. Full value of this whole package is $2,437. So this will be $197, but today I'm giving you that discount of 15% off, so it's $167, okay? So all you have to do is come down here, click on this buy now right there, and then once you click on that, you'll see the drop down, it's $197. It'll show you kind of what you're getting for the course, and then come in here and put that promo code, just make sure you put it small cap, EARN, let me see if I can spell that right, EARN 15, and then punch apply. Now, if you want my indicators, you can also get those right here as an add-on. Punch apply, and you'll see it's $167. So that's for the course, all the bonuses. If you want my alert service to combine with it, which we'll talk about a little bit more in greater detail a little bit later, you can do that as well. So here's the course package 2, which includes my elite open and close trade alert service. So with this, you get you'll get all 5 of my different alerts that I send out, and you'll get those for the next 4 months, plus the trading club for the next 4 months. And with either one of the package, you can start the service when you want, so you don't have to start it right away. And with this one, you can start and stop. So if you do go on vacation or whatever, you can stop it and then start it back. So With this one, you'll get my alerts, 5 different alert trade kind of setups that I send out for the next 4 months. The Trading Club, just a real quick kind of brief summary here on the results so far. These are non-audited, but since I started it back in 2018 through Friday, we've run about a 79% winning rate. Okay, so 749 trades closed out, 541 winning trades, 50 break even, 158 losing trades over that period of time. Really good high winning percentage trades. That's what I look for. So you get all 5 of the alert services for 4 months, Trading Club, and everything in course package 1, and that's $597. But today, if you want to take advantage of it, use that promo code there. And so, I'll send out 8 to 12 stocks per month, stocks or ETFs. So I send out, these are very selective. I'll send out breakout reversal trades. These are typically would be at credit spreads. We do send out a lot of counter diagonals, a lot of selective butterfly long condors, and selective earnings trades. So we're starting to get into earnings season, so I'll be sending out selective earnings trades. And then we have another pretty cool trade setups called kind of monthly butterfly calendar pinning trades. So these are the 5 type trades that you may get an alert to. And so you'll get a trading guide, trade sets, videos on those. These are listener archive. And so you'll get all of these for the next 4 months. And then I do a video newsletter every day for the next, you'll get that for the next 4 months. Now, if you do the package 1, you'll get this 30 days of all this stuff. And then access the virtual trading room, my trading room for the next 4 months every day. And 6% discounts on all courses and trading software. So all that will be $597, but then use that promo code, and this is going to drop that price down to, I'll show you here, just go in here and click on course package 2, and then put in, you'll see everything listed here that you get, put in again that code EARN15, and you'll get 15% knocked off of that. So drop it down to 507. There's also 2Pay if you wanted that as well. All right, so just kind of wanted to go through that, make sure that you could take advantage of that before we get started in case you do have to leave early. And again, this will start next Saturday, and also it's live, but it will be recorded if you can't, make it all or parts of it, So try to make it as flexible or, easy for you as possible. All right, so just use that special link here. I'll put it in one more time, and then we'll move forward. So plenty of, let's see, can everybody hear me okay? Double checking mic test. Got one person said they lost audio. Okay, good. So let me just send her a note. Oh, okay, hold on. Hopefully that'll help her. Okay. All right, so take advantage of that if you like. Join me next Saturday. And anyway, so let's get moving. So here's a kind of the first kind of a bucket of trades that I look for. So these are the volatility crush earning strategy. So this one is the long iron condor. It's a credit spread strategy to take advantage of that spike high implied volatility going into the earnings release. And so, why trade the credit spread? Well, first, it's a defined risk trade. So it's also non-directional. So, we don't care, which way the stock price goes. We're looking for a contained cap trade, okay? And so I've got a screen that I do that's really makes these really high probability trades. So it's really increased the winning probabilities, the screen that I've come up with. All right, so that's something new that I'm using. So you'll find out how to do that at the course. We'll talk about that. And then takes advantage of that pre-earnings high implied volatility. So that's what we want to take advantage of with this. And so we're selling basically with this kind of strategy, we're selling time and volatility, which both go to zero at expiration. So for certain stocks, this is a great strategy to use. And so again, this is going to profit from that volatility collapse on that extreme implied volatility that heads into earnings. So trade duration on these are typically would be 1 to maybe 3 days. So these are all really short type duration trades that we're just playing specifically for the earnings, hyped up, increased volatility, and the potential for price spikes. But this one is to sell volatility. So here's a couple examples. And this new screen I have is really makes these a high probability trade. What that means is that the chances of winning is super, super high on these trades if a certain thing happens that I see with the screen, which we'll talk about and I'll show you in the course. So here's just an example of on Apple. So we're playing the volatility collapse is basically what we're doing. So if you look here in this example at Apple, it was trading at 165.79, expiration next day, so 1 day later. So the expected implied move was for a move up 4.2% up or down. Now, if you look at where Apple is trading, it's trading here is 165.79. If you look here at that 175 strike, we're looking at right here just to look at 175. Let me make sure. Here's the implied volatility, and here was trading at 165. So right here, well, a couple things you can see here is that 175 strike is what we're going to look at for one of the outside points. But you can see the implied volatility on that specific price is 61.41%. All right. Now that's going into the earnings release. All right. So the implied volatility is really spiked up. All right. So just to kind of illustrate, what we're looking at there. So then the next day after, you can see the 175 strike. Look at the implied volatility crush or collapse. So now the next day, that implied volatility is collapsed down to about 10%, 9.5%. All right, so the price went to 173.57. Volatility collapses. So I'll back up one more time so you can kind of get a better grasp for it. So here it was the day before. It was trading at 165.79. The implied volatility on the 175 strike, this is one of the short strikes that we're looking at further out of the money, was 61.41%. And then the next day, you can see the price spiked up to 173.57, but look what happened in implied volatility, it collapses. So that is typical of any kind of earnings trade. And we can then take advantage of that collapse by using what we call this iron condor credit spread strategy. So here it was, the expected move going in was for, the market was saying, okay, one standard deviation move up and a kind of normalized move based on the implied volatility. It could be up or down 4.21%. And the next day it closed up, 4.6%. So what we're looking at doing is taking advantage of the selling that implied volatility. So we want to kind of cap the trade. And so sell, basically what we're doing is selling upside call credit spread and a downside bull put credit spread to kind of cap the upside potential move. Try to do this greater than the implied expected move. And this one screen that I use, which I'll teach you and show you in the course, really shows you how to really get selective to really pick the high probability stocks that will have a tendency for this kind of collapse, very high winning percentage of these types of trades based on the screen that I'll show you in the course. So here's just this one though on Apple. So you can see here what this trade structure looks like. So it was trading at 165.70, expiration the next day. And so this was, looking to trade that, what we call the iron condor credit spread. So we're going to be basically selling a call credit spread, selling a bull put credit spread. And we're going to do this, trying to have the price movement be contained below the expected move or within the expected move or something. So we want to, typically I'll do these, try to do a little bit outside the expected move in order to get enough premium. But in this case here, you can see the risk reward profile is basically, with this one, if I can get my pen to work again, you're setting this up, you can see it's selling the 175 call by the 177.5. So here's your call credit spread, and then selling the 157.5 bull put credit spread right here, bringing in the two spreads together, brought in a total credit of $60. So this is a probability trade. So this is typically what you're looking at as far as the risk reward profile. So you're risking here, it's a $2 wide or $2.50 wide spread. So you're risking $190 to make 60, but it's a probability trade. So, in the course, I'll go through the probability analysis in great detail in the screen that I use to show you the probability of, why you would set this trade up. So that's taking advantage of that implied volatility, that really high volatility skew, and how we can take advantage of it for the collapse. So here's kind of what the trade profile looks like. So you've got that bear call credit spread out here and the bull put credit spread here, okay? So we're looking to have it contained within these two spreads, just trading for that volatility collapse by selling volatility. So you can see where this trade was set up. You can see it broken down. The call credit spread side, the 175.77.5, we brought in a credit of $25, so that goes to zero, so there's your profit there. The bull credit spread side brought in a premium of 35. So there's your total potential profit is then $60 per spread. And, it collapsed here and went out there. So we had the max profit, but that's to sell volatility. So that's one trade setup, and it's based on a certain screen that I like to look for to really screen out, looking for high probability setups for this collapse where they don't go far. So here's another one. This was on JP Morgan, and this one was a really good one because this had that kind of screen parameters where the prior earnings had a certain thing happen that made this a high probability that the next series, which was this one, would be a very low move on JP Morgan. All right, so here it was set up based on that screen. So looking here for JP Morgan, well, this one is going to be one that we'll look probably to do next week because it's kind of set up for this strategy next week, and JP Morgan will be next Thursday. So I'm probably send this probably out as an earnings alert trade. But you can see the expected move on this example. This was back July 13th. It was trading at 148.87, expiration the next day. So the expected move going into the release was 2% up or down, 2.86% up or down, and it closed 0.6% up. All right, so it's right here. It's pretty flat and very muted move to the upside. So total taking advantage of that volatility collapse. And this was based on that screen that I'll teach you the screen, how to use it next Saturday, for this specific type of trade. So here it was going in, the profile on it. So this was a total credit of $65. Again, this was a $2.50 wide spread on the call side, and then a $2 wide. So this was kind of what we call kind of a broken wing iron condor credit spread. So it was like this, but anyway, so the total credit brought in was $65. The total risk is the difference between the spread width was 185. So this captured the full credit because it's a really good screen that shows that. So it went out, you can see here on the 14th, it was up, kept the full premium of 65, so 35% return. So these trades are, your typical return will be 35, 40, 30 to 40%. That's typical on these kind of probability trades. So if you ever do iron condors in general, that's typically what you're going to make, anywhere from 30 to 40 to 50%. It just depends on, where you set your short strikes, either closer in or further out. That's going to dictate how much premium you bring in. So this one was set up pretty tight based on that screen that ran for it. And so here was the call credit spread side. Here's the bull put credit spread side. And for the combined credit brought in was 65, and then it went out right in the middle, didn't move. And so that was based on the screen that based on the screen that I'm using now, showed that this would be a really good one for a very muted move, either up or down, based on what's happened prior, based on the screen that I'm using, which I'm really excited about, and I'll show you how to use that at the course. So this would, went up and closed for max profit of 65, so 35% return in that one-day period, just taking advantage of volatility collapse. Now the next type of strategy that you can use, and this is one designed to take advantage of the potential for explosive price spikes. Okay, so this one is actually an iron condor, but it's the iron condor debit spread. All right, so this one is constructed for when you have big explosive moves up or down after the earnings release. So it's also a defined risk. It's a debit spread. It's also kind of a non-directional setup strategy. And this takes advantage of the earnings release price spikes that certain stocks have a tendency to have these big moves. So profits from that explosive price spike, trade duration, kind of 1 to 3 days is what I look for. So here's an example of one for, this was on CRM. And CRM, the going into the trade was, it was trading at 230.35. Expiration was going to be on the 1st of December, you can see. And then, so the exit was on the 1st, and it was now trading, it went from 230, it was now trading at 260. So it was up 12.87%. So the expected move, though, going into the trade was for a move of up or down 4.88%. But this was set up to take advantage of the potential for a big price spike up or down, and it got it with that huge move of 12.87%. So you can see here going into the trade, it was trading right there, but look at the implied volatility, collapses. But with this potential, when I look at these different stocks, this one was poised for, based on the screen that I like to do, was poised for a higher probability of big price spikes. So this tells you not to sell the implied volatility, even though implied volatility collapses. If you had done an implied volatility trade here, like selling the iron condor credit spread or the calendar that we'll talk about next, you would have been crushed. You would have run straight through your price strike. So that's why it's really important to match the certain stock that has certain tendencies with the right spread, right strategy, versus most traders just saying, oh, I've got to sell implied volatility. I've got to sell implied volatility. Well, a lot of times that's not going to be the right strategy because you're going to get blown through on a price spike. But in this situation, if you use this strategy, you could have profited from that price spike. So that's the point of this trade, okay? So here's the trade setup going into this for the price spike. So this is the iron condor debit spread. So the expected move again was for a move up 4.88%. This trade, though, based on the statistics that I was looking at, we set it up for all it had to do was move 3% up or 4% down from this to be a max profit. All right, and this was based on looking at this trade for potential tendency to big price spike. So it did price, it spiked up to 260, so it was up 12.87%. So the max risk, the spread was $82 per spread profit. The risk was the difference. So 168 risk, 82% or $82 profit. And this was a $2.50 wide, what we call the iron condor debit spread. So what we're doing here is we're looking for big price spikes. So all we wanted to do, we don't care which way, we just needed the big price spike. So we're basically long a call debit spread, long a put debit spread, and we're setting this for a 3% move up on the call side, 4% move down on the put side in this particular setup that I did. And then if we get that move, boom, we're going to get that. In this situation, it was done, risk was 168, the difference was your profit 82, and you keep that. That was it was a 49% return in this short period of time for the trade. So here's what the trade looked like going into the profile of it. So you can see again the setup structure here. So it was set up to be long that call here, the 135, short the call here, the 137.5. All right, look where it closed right there, boom, exploded. Or the other side, didn't know if it's going to go up or down. But what I did want to take advantage of was a move. This was set for a 3% move up. The put side was set for a 4% move down. And this thing exploded and was up, 12%. So right here. So max profit. So you can see the debit spread side was set at 84 bucks, blew out to 250 max profit on that, lost the 84 bucks there. So that's how that spread turned out. So $82, 49% return. So if you're looking for, these are all structured for the different things that can happen during earnings release type trade. So this is for the big price spike. Now the next one is kind of a go-to strategy that I like a lot due to the low risk to reward and what I call flexibility that this kind of structure adds. So this is what I call the double lightning earning spread. So basically it's a double calendar. Now with the double calendar, we can take advantage of, for one thing, it's very low risk, okay? So the cost of the trade is going to be a debit cost. So what your debit is your risk. But again, it's structured to initially be a non-directional earnings release trade strategy, structured for low defined risk. But it then takes advantage of that pre-earnings high implied volatility, because with the calendar, we're selling the front short duration option and buying the options behind it. So it's a really great structure. But the other thing that I like about it, it gives you the flexibility. If you want to hold the trade for a post-earnings move, you can do that because you're long further out on your long option. And this is what we'll go through in the course, how to set this up and how it's used. So basically, we're selling time and volatility, and this is going to take advantage of initially the profit from volatility collapse, but then it allows you the flexibility if you want to stay with the trade for to profit from any post-earnings trend trade up. So it could be up or down, it doesn't matter, because you're set up with the calendar. You know, you could do you've got a call calendar side and you've got a put. So it doesn't matter which way it goes, you can take advantage of it because it's a double calendar. So trade duration on this can be 1 day out to 1 week, because we can we can stay long for the post-earnings trend if we want to. It's always going to give us positive data, so no time decay as well, which is a great part of the trade. So what really sets the trade apart again from the others that also sell volatility is that it can be adjusted into a directional trade after the earnings release, providing potential for big profits from the post-earnings directional move. So I started using this back in 2020, just kind of figured this out, that this would be a great one to use to take advantage of selling volatility, but also we can stay with the trade if we wanted. So it's been a really good one, for certain stocks. You don't do it on every stock, but there's certain things that we look for, and that's what we're going to be going over in the course. So started using this back, again 2020, but started the alerts back in 2019. And these are very selective trades that I send out. I don't send out a whole bunch of them, but they're very selective. But of course, I'll show you exactly how I do the trades, the different structures, and the screens. The screening part is the big part. So we've had 123 closed out, 88 winners, 16 break even, 19 losers. Really high winning percentage. Very, very selective on what I'm looking for in these trades. All right, so that's kind of those are not audited, but that to show you kind of the potential that you get with these trades. So here's an example. This was one on STZ. Okay, so here are two different examples that I'll show you. So with STZ, you can see the implied move kind of history statistics here. Has tendency for 3.5. Here's expected move over kind of 4 cycles. I can go back further, but this is typically I go 3 to 4 cycles and look kind of what is the tendency. So typically has a move, expected move 3.5% up. Now then I want to do, okay, well then what does it typically do over its past history? So you can see here it was up 2%, down 3%. Here was flat, up 1.4. So the moves are kind of pretty much contained around the expected move. And what we want for this strategy is we want to set it up to kind of hit the expected move, or sometimes I'll set it up for a little bit inside the expected move. So it's basically looks like this is what we call a double calendar. And what we're doing in this strategy is we're trying to hit the expected move or inside the expected move, up or down. Okay, so we have the potential, we have a call calendar and a put calendar. And so if we get a move, let's say in this example, we set this up for 3% up or down. So we get a move to 3% up and we hit this area here, we're going to get max profit. And we've got this it's kind of like a butterfly almost. You've got this profit zone in here. But if it goes down, we've got it set up for the other way with the put calendar at 3% down. All right. So, but what makes this really attractive is that first off, the cost of the trade is a debit, and it's a very low risk reward trade. So you're going to be risking a lot less. And the potential reward is typically going to be greater than what you'd get if you get a credit spread, which a credit spread is going to give you a negative risk ratio. This will give you a positive risk ratio if you hit it right. But the other thing we can do is we can turn it into a post-earnings trend trade if we want, because we're long the further out long call or long put, short closer in on the call side or put side. Okay, so it's a really unique strategy, and this is what I'll show you in the course. So here's an example. This was on STZ, the double calendar, and the expected move was 3.5% up. Trade was set for 3% up or down. Okay, and so it was set initially to take advantage of the implied volatility collapse, but also by doing it with this double calendar, we could keep our risks very, very low and have potential for actually a bigger return on our risk than just a normal credit spread type strategy like the iron condor credit spread. So here you can see the implied volatility here going in was 86.45, so positive skew. You can see how the high implied volatility on that short right there, that duration option there. And then what we're going to typically do, we'd be short this series, long the series behind it to take advantage of that implied volatility positive skew. All right, so I'm just giving you a brief go around, but in the course, we'll get into this in much greater detail. All right, so then you can see here, the next day, it went from 242.30, now it's trading at 247.53, implied volatility collapsed, see? Implied volatility was 86%, the next day it collapsed. So this is taking advantage of that volatility collapse, but also doing it with a better risk ratio versus a credit spread. So in this trade setup example, STZ was trading going in at 242.33, expiration the next was the 5th the next day. Expect to move 3.5% up or down. Trade was set for 3% up or down. The break even is really great break even points as well. It would have to go up 4% for the break even on the upside or down 5%. So the trade was set up here. Cost, the max risk on this one was $150, and it was traded on the 5th at 247.53. So you can see here it went from the spread went from 150, now it's trading at 330. So this was up $180 per spread. Okay, or that's 120% return. So you can get this really potential positive risk ratio type returns versus your credit spreads, which are typically only going to get maybe 30, 35, maybe 40%, on those type of probability trades for selling volatility. So you can see here it was the cost of the call calendar was like 75. The cost of the put calendar was 75. So total cost was 150. And then you can see the spread where it went, it blew out 293, and this one collapsed at 38. So you had a, spread at 330, cost was 150. So this is what makes it so attractive. Now, the other thing too is that if you wanted to, let's say, hold long, you could do that, because all you have to do is, if you wanted to, see you're short that in this example, the 5 Jan, you could close out the short call, you could stay long the long call for another week. So you close out the put side, close out the short side of your call that you're short, hang on that, and if you think it's going to trend up, you can still play it to the upside. What we'll typically do is then we'll adjust a lot of times. If we stay long, let's say a call, we'll convert that to a call debit spread or maybe a butterfly. So it gives you a lot of what I call flexibility as to what you can do. So this is a really cool strategy for these types of trades. Here's another one. This was another one that we had set up. This was on Colgate, I guess, CL. And you can see the implied expected move history was not for huge moves, around 3% up or down. And you can see what it typically, would do would be within that, 2%. You can basically, so very, very not big, huge movers. So that's the other thing. I don't want huge movers for this type of strategy. So this is kind of what I typically will look for. But again, in the course, we'll go through all the different steps and actually how to set this up, because there's quite a bit of detail to it, and that's what I'll teach you in the course. But so the expected move on this was going in 2.83% up, and so we set this up for 2.5%. Okay, set it with less than the expected move, and that was based on, if you look at the stats here just quickly, I'll back up. You can see this history here kind of shows you that this expected move is close to 3%, but it actually doesn't move that much. See, it's more like 2%. right? Maybe 2.5. So that's why this was set up a little bit inside the expected move for the double calendar. All right, so set it up for just a 2.5% move. So it's trading here, ended up going out there, and so this closed up 2.3%. But here's the thing that makes this so unique. Look how cheap this trade was. First off, here's the implied expected move. Here's the implied volatility. So it's trading at 80.96, 1 day at expiration. The 83, this was part of the call calendar side. The 83 call was going 46.42 implied volatility. All right, so then the next day, to show you how that collapses, the next day that 83 call is now collapsed down to 14%, and the price is trading 82.76. But here's the thing that makes this so pretty amazing is that these things can be so super cheap. So look at this. The max risk on this trade setup was $17. Okay. All right. So you can see here. So the call calendar, the 83 call calendar, you know, long the 2 Feb, short the 26th Jan was $11. That was the total cost of that calendar, $11. Okay. The put calendar side was, you know, short the 26 put, long the 2 Feb put, 79. Cost of that was $6. So the total risk on the trade was $17. So that's what makes these just pretty unique. And you know, you don't have to stress too much about the trade. You know, you lose $17. That's not going to, you know, end your trading career, right? So then the next day, actually, this was up to 82.83. So it was up almost perfect right into that call calendar side. So it was up 2.3%. And so this trade was now, if I can erase this real quick, this trade went from $17 spread, now is trading at $53, okay? So it was up $36. Not, I mean, that's not a huge profit, but when you look at that on a return of your capital of 17, that's a 211% return. So just, you know, that's what sets this kind of trade structure apart from the others. But again, it's for selective type trades, which you have to then, you know, understand and look to screen for these types of trades. Now, the next one we'll you know, kind of discuss is the post-earnings trade. So this is using a pairs trade strategy, which is a market neutral trading strategy. And this is a really good one for if you want to take advantage of a post-earnings trend after, you know, release of the earnings. Now, when we're trading pairs or spread trading, it is a kind of, again, a market neutral strategy that can be used for trading a post-earnings trend move on a stock after its earnings release. So by trading in pairs or spread, this really helps to mitigate overall market risk. So by simultaneously taking opposite positions on related securities allows you to then reduce your exposure to broader market movements. So in other words, if you do a pairs trade, you're going to be equally likely to profit whether the market you trade is going up, down, or sideways. It doesn't matter. So in the course, you're going to learn how then to select the ones to trade, and then how to use and set the trade up using what we call a synthetic option structure versus, you know, having to buy the underlying shares and sell shares against it. So we can do this using options, which makes it more efficient, less costly. Now, when you look at a pairs trade, think about a spread. So let's say, you know, for example, well, I'll show you an example on Apple. So, or Nike, anyway, here's an example. So let's say you've got let's say you go long Apple. You like Apple, so you go long Apple. Now you could pair that with something Apple's correlated with. So you could pair it with, you know, something that typically we'll pair it with like the QQQ, you know, or it's part of the XLK. All right, so those are two different things that we could pair it with. So we thought Apple's going to be stronger. We could go long Apple, and we could short against it something that's, you know, within the sector of the QQQ or XLK. So we just play the spread strength of Apple, thinking Apple's going to, you know, be stronger than QQQ, and we don't have to carry or worry about the market. So the markets go up or down, but as long as Apple stays stronger than QQQ, we're okay. Now, we could also, then we think Apple's going to be weaker. We could be short Apple, long QQQ. All right, so for example, so then if Apple goes up faster than QQQ, so Apple goes up faster than QQQ, that spread widens, you make money. Or let's say that Apple goes up, but QQQ goes sideways, we're going to make money, right? Well, let's say that Apple goes sideways, but QQQ goes down. We're going to make money on that spread. It's widening out. Or let's say that Apple declines more slowly than QQQ. So Apple starts going down, but QQQ goes down a lot faster. So that spread starts to widen. Or, Apple goes up, QQQ goes down. So you can actually make money 5 different ways, and you're not worried about market direction. You're just playing the relative strength of, whatever you're pairing. So Apple to QQQ or whatever it might be. Now the pair trade then can be structured, then we can do this without having to actually buy the shares. So we can do it using options and doing it by what we call a synthetic long or short option trade structure, which is going to mirror the underlying stock or ETF position that you're wanting to pair. So this will lower your trading costs and ends the hassle of borrowing shares. So this is what, I'll teach you how to do this pairs trade for post-earnings trend trade move using synthetic options at the course next week. So here's just kind of an example. And this one was Apple. We'll say this is earnings one. So Apple had a move here and it was really strong. So earnings, and the earnings is what creates the catalyst for this correlation, the pair. Sometimes it can make it, make Apple maybe stronger than what you pair it with. And other times here you can see Apple had a horrible earnings and goes down. So Apple, you might pair this with something for Apple to be weaker versus what it's correlated with. All right, so you can see here it just had a really explosive move, big trend up. So we could actually structure this with the pairs trade long Apple in this example, and short, I'll show you in a minute, QQQ, or we could do it the other way around. If we think that Apple looks relatively weak, which, and here it was, we could do it the other way around. We could be short Apple, long QQQ, or, if you want to look at it, long QQQ, short Apple. All right, so then we can do it using these synthetic options to do this. So here's just an illustration just to show you the spread though. So this would be like on a one-to-one basis if you just did 1 share of QQQ, 1 share of Apple. So here's Apple, here would be QQQ long, Apple short, okay? So here's QQQ actually. So here's the spread. This is like QQQ long, Apple short. Even with Apple being strong to the upside, QQQ was stronger. So here it goes from here. You can see if you just follow the spread, Apple was trading right here at 150. Now this is spread. So here you'd be long QQQ, and you'd be short against it, actually Apple, okay? All right, so at that point in time right here, the spread was QQQ was $152 over Apple, okay? This is like one share, 1-to-1, all right? So you do 1 share, 100 shares, whatever, but that's the relationship. Now, QQQ ended up just getting stronger and stronger relative to Apple. And at this point here, on the 18th of July, that spread had moved out to 191. So now QQQ long, Apple short, QQQ was $191 above Apple. All right, so here's your difference. So it went from 191, had a max move up here, and if you'd done the spread here, 152. So this is share to share, just to show you how that works. This would have been a move of $86 per share, right? Now, if you did 100 shares, that's $8,600. All right, so that's how a spread works. So the really, really great way to play it, and you don't really care about market direction. You're just playing that relative strength between, in this situation, Apple was weaker than QQQ. And then here was the other, you can just see it here again. Then here on the 3rd, August the 3rd, it was trading at right here QQQ now was 183 over Apple, and it had to move up here to 201. All right. So another one. So this was up then $18 per spread. So that's what you're looking to play, and the earnings are what can break a correlation after the earnings move. Here's another example. So here is Nike, and so here was Nike, and here's the earnings right here. So Nike came out here on the 29th, and it was trading right here at 113, right here. Okay, bad earnings, started to collapse, started trending down. Look at this trend, okay? So the earnings is what created the catalyst for it to move lower. So what we can do here is we can, if we wanted to do a pairs trade, and this one we'd be looking to short Nike and then go long something that's correlated to it to offset that market overnight risk, so make it more neutralized. So here it was on the 29th, it was going down. Here it was on the earnings too on the 28th. Right here, and you had to start to get a break to the upside. So here's one, and this is one that was done with the options. Okay, so here's the spread. So this is going to be, well, this is doing it more correlated 1-to-1. So what we do is we adjust the balance. We make it more dollar equivalent. So with this one, we're doing it with Nike versus SPY. So we're buying 1.5 shares. We're buying right here. You can kind of see it right here. So this would be, we're going to buy 4.55 shares of Nike to sell 1 share of SPY. So that makes it more balanced. Now in the course of then I'll show you how to do this using options instead of having to do the shares. But this is just to show you that spread correlation. Okay, so here again, if you look here, so here was Nike right here. If you shorted this with this ratio, 4.55 shares of Nike, okay, just to show you the spread relationship right here, that at that point was at $72 right here. All right, so 72. Okay, in the course then I'll show you how this works with using options, but here's just to kind of show you the relationship on a spread. And then you see that spread just here just goes down, right? And so if you then short Nike long SPY, that Nike just got crushed, okay? And so now it was now at 14 under. Now Nike was trading at $14 per share under where it was when the spread was set up right here when it started, okay? So that was a move of, basically $86 per spread. And so that was a move of $86 per spread, so one spread. And if you did this with the options, one option contract, 100 shares, that'd be a move of $8,600. Okay, so from there to there, and this is a kind of a delta neutral because it's done with the spread. So if the market's going up or down, it doesn't matter as long as that spread relationship Nike is weaker than SPY. So that's the whole premise of the trade. And so here then you can see it turns the other way. And then now you can see that spread, Nike starts improving. Okay, so here's Nike trading at $2.50 under SPY, and then Nike starts strengthening and it starts getting stronger versus SPY, and then now it's up to 81 over. Okay, so here then that's an increase of $84 on that spread. So if you did one option contract, that would be like $8,400. So that's the beauty of a pairs trade. And then we can set these up using a synthetic option structure to make it more cost efficient and cheap. So those are things that you're going to learn in the course next week. So will every trade be a winner? It'd be great if it could, but no, unfortunately not. But the whole really key to this thing is kind of using this kind of systematic approach for finding the highest probability type trade setup. So a big part of these types of trades is to select the right trade and then matching it with the right strategy, for the trade to work. So a big part of the course next week will be going through the screening process, putting together the different watch lists or buckets, and then matching those to the spread trade strategy that we're going to use. And so I'll go through the details of what we'll cover in the course, and then take any questions you have. So let's go about finding these high probability trades using weekly options and more, and let's get started. So for the course, again, I'll start next Saturday, the 13th. We'll start 11 a.m. Eastern to 2, and then we'll follow up Monday, the 15th, 4 to 5, or however long it takes to get all your questions answered, get everything done, and then we'll do a Q&A the next day. So you'll have plenty of time to make sure that you get all your questions answered, and we'll take questions as we go. And then again, you're going to get the 6 enrollment bonuses, and just again, to make it real easy, just use this link here. Use that special powercycletrading.com/special, or you'll see down below here, if you wanted to use a specific link, you can use this link here, which I could give you if you want. So it's just the powercycletrading.com/1earn. This will give you this package here. But if you use that link that I just posted, click on it, then you're going to get everything here, all the bonuses, everything you see here, full course value there. It's $197, but use that earn 15, and this will drop your price today. You'll get it for $167. Okay, so again, use your earn 15, EARN 15. Use that small cap. Apply that to that special link that I gave you, and you're going to get the 15% off with all those bonuses. Now, course package 2 is great for, if you've been looking for more help and guidance in your trading, then this is what you're going to be really wanting to take. So this will include my 5 trade alert services for the next 4 months. Plus, you're going to get for the next 4 months the Power Cycle Trading Club membership and everything in course package 1, which was $197. So just backing up course package 1 real quick again. Here's everything you're going to get. So you're going to get the course, okay, 4-hour plus course. Then you're going to get to start off this week. You're going to get right away my earnings option course that I did prior on demand. So you get that right away. You'll get 1 30-day trial membership to my trading club. All right, so you can start this when you want. You don't have to start it right away. If you stay in, it'll be $97 a month, or we have other type of packages that you can do. And then you're going to start trading options today. Another really nice option course. You get that. We'll do the follow-up support Q&A. How the pros use the Greeks, so another short course on the Greeks, okay? And then my trading watch list based on 3 different scans. Now in the course, I'll teach you these scans and how to do it yourself, but you'll get that right away. And then, we'll do the live course, and it'll be recorded, everything broken down, 30-minute modules, so you'll get all that. And you'll get that today for $167. Now, with the alert service, that's just including the alerts. So it basically comes out, you're paying another $100 a month. If I can get this clicked right. So basically, if you want the alert service, it really comes out to, you're paying another $100 a month for the alerts. So, but you're going to get all 5 of my alerts. So it could be a butterfly long condor that I send out. Could be a calendar counter diagonal. Could be a monthly butterfly calendar option pinning type trade setups that I send out. Breakout reversals, these are typically going to be either a debit spread or a credit spread or a selective earnings trade, okay? So again, use that special link, or you can do here down powercycletrading.com/alert earn. So with this, you're going to get everything for 4 months, all 5 services, 4 months of the trading club. So when I send out the alert, it's really based on, what's the best, what I'm seeing as far as the best trade setup that I'm looking at. And it might be one day where it might be that we want to do a butterfly or condor. And I'll go through and I'll show you some of the trades that we've done recently. Or it could be this trade that we're looking at for some kind of breakout or cycle reversal is better to do. We're doing it as a calendar or counter diagonal. Or it could be we want to do a pinning trade. So you might get that. Or it could be we're going to do just a debit spread trade or a reversal trade using a credit spread, or a very selective earnings trade. So it could be a double calendar earnings trade, or it could be an iron condor earnings trade setup. So these are the things that you'll get as far as the alerts that'll be sent out. So then when I send out the alert, I send the trading guide for each alert. Now, a lot of members just do their own thing. They just want the trade, and they'll just either buy the shares or short or do whatever they want. But I'll always give you an option trade setup that I would recommend for the trade. So then I do a trade setup video review that night, later in the day, to show you why I was doing the trade. You know, what we're looking for is why it was set up. Trades are listed and archived. Then we do a weekly Q&A, typically every Tuesday, but these are live and recorded, so you'll have that access for the next 4 months. Then I do a video newsletter every day after the close, access for that 4 months. And then the big benefit is you get access to my virtual trading room for the next 4 months. So this is a trading room setup. We open at 8:30 Central to 9:30 every day, so you can come in and see what we're doing, or any specific questions you have, come in. You need help on a trade. That's what's a really good setup for the virtual trading room, for any coaching ideas or anything that you need help on. And then you're also get discounts. Anything on my website, you'll get 60% discounts off any other courses or software. I've got a lot of software technical indicators, and you'll get 60% off. So there again is what you can use. So go through that, select the one you want to do, and then just one more time we can go through that, and then I'll go through and I'll show you the additional bonuses and show you some of the alert service trades that we've done recently. So again, come down here, and you can see here's countdown clock. You've got a few hours here before it goes to 0. So just come down here, click that buy. Here's course package 1. Just put in earn 15. Remember to do small cap, and you'll get 167. And then if you want the alert services, included, just come down here again, same thing, just click that course package 2, plug in earn 15. You can do 2pay if you want, click, you get that for 507. So that's makes it pretty easy, and you can see what you're getting. So here's just the lead open to close trade alert service. Again, we've been through since started this back in, actually the first part of the service back in 2018. Wow. And through Friday, we've had, again, unaudited, but the summaries, we've had 749 closed out, 541 winners, 50 break even, 158 losers, running a really high winning percentage. And this is a combination of the 5 different types of strategies that you might get, depending on, what's the best one for the market we're trading, or whatever, the trade setup that I'm seeing. So the earnings, we've had, again, here we run about 84% win rate there. And then here's what we're going to cover. Here's a summary of the course. So how to capitalize on earnings season uncertainty with these different option strategies you're going to learn. So we'll go through part 1 and 2 are going to be live, and then you're going to get another part to the course, which is 3, which will be on demand. But this is the live course that we'll start with starting Saturday. So we'll go through the 5 steps to the perfect trade setup, the analyze tools, and the resources I use for getting the data to analyze the different earnings trades that we're looking at. To put together our watch list, the screens that we're using. I go through 7-step screening process to identify these kind of high probability winners. We'll go through that. We'll spend a lot of time on the screening process, because that's really where you make your money, is finding the select the best trade. And then we'll go through the option pricing, the importance of then using weekly options. We'll go through my resources, the statistics that I'm using for the earnings history for all of the stocks. You'll get that. Then how to set up your scans, how to quickly set those scans up, to capitalize on this kind of earnings data. And then how to analyze the stock earnings release move and the post-earnings move to select the best weekly option strategy to use. And then the formula to create an efficient watch list for your trade setups with the highest profit potential of the trade. So very, very, very important to select to go through the selection process of scanning. And then we'll get into then we'll get into the trade setup. So we're going to cover the live course. We're going to go through the Iron Condor, this high probability credit spread setup for volatility collapse. So this one is a really the screen that I'm using now really increases the probability of these trades that we're selecting for the credit spread. And then we'll go through the Iron Condor debit spread for the big price spikes. Yeah, there's an option. To buy the indicators. The indicators work on Thinkorswim, TradeStation, and NinjaTrader. I believe it shows you. Let me pull it up. Okay, so we'll get back. Then we'll go through the Iron Condor debit spread for price spikes. You'll learn that strategy, when to use it, and then we'll go through the double calendar. Okay, so that's a really big one that we're going to cover in great detail. Let me pull up the link real quick here. You pull up the indicators. I'll show you real quick here. What it should tell you which what you get. The indicators are available for Thinkorswim, TradeStation, NinjaTrader, and TradingView. Okay, so you can have one or all of them. And so here's what they look like on Thinkorswim. So basically, you're going to get these momentum indicators, cycle 1 and 2, and reversal indicator here. So basically, this is what you're going to be looking at. Okay. So this is, if you go to my website, these are, I believe they're, here I can show you, they're $390 something, but right now if you wanted the upsell, it's $195. Yeah, it's a one-time purchase. You don't have to do anything else. They're no license, or you don't have to, renew every year. They're yours. Boom, it's one-time purchase. Okay, so yeah, so that's basically what you're getting there. And then, so we're going to go through these 3 strategies. Then we're going to also cover the pairs trade. But you can see here, this was it's absolute best earnings strategy I've found, as well as overall excellent option strategy, period. So you're going to learn in depth how, why, and when to use this dynamic strategy based on my 10 trading step guide. So we'll go through in great detail in the course on this strategy, the earnings double calendar, how to choose the optimal option price, prices for your strikes, how to structure the initial setup through the option expiration with ease and perfection, steps to adjust. So a lot of times, if we do this into a post-earnings trade, this is what makes it so great. We can adjust the double calendars to, a lot of times, into free trades with zero risk. And I'll show you a couple that we've just done recently where we did adjust to zero risk. All right, so then part 1 and 2 again. So then we're going to go into the earnings pairs trading strategy. So again, this is a spread strategy for market neutral that can be used for any trading a post-earnings trend move on a stock after its earnings release. So the strategy will then totally change the trading game in your favor during high volatility markets, regardless of market direction. So that's the great thing with when you're playing spreads or pairs, and that's why hedge funds are called hedge funds, because they're long short. So it's great because then if the market goes up or down and you've got the correlated strength right on one of your pairs, it doesn't matter. So we're going to go through then on the pairs trade, how to identify and select the best earning stock pairs for trading, how to statistically measure a pairs trade correlation to identify the best pair trade matchup to use. So I'll show you how to measure a correlation, when and then how to set up the earnings pairs trade, how to lower your pairs trading costs using a synthetic long short option structure. So you're going to learn all that. So there's a lot that will be covered in this course. And then you're going to get part 3 additional, but this is recorded on demand. You're going to get just even more content information on these kind of 3 strategies, the iron condor, long condor, the long iron condor, which is your selling volatility, the long iron butterfly, selling volatility, the short iron condor price spikes. So then earnings option strategy, each strategy explained in depth how, why, and when to use, how to structure the trade based on its pre-earnings implied move history, how to calculate the implied move, how and when to set the trade up, how to manage, and then you're going to get a trading library that you can go back and look at a lot of old trades, which to me help learn a lot when you look at old trades that are, winners or losers to help you understand how they work. So you're going to get a really extensive trading library. Here's just an example. This is over 40 trades, but you're going to get, actually, I've added more to it than these. So things like Apple, Google, just a lot of stuff that we've done. So you get those trades, you can go back and review. This was really nice review by Mary. She said, this course explained in clear and simple terms how to trade options on stocks that were coming into their earnings report. Larry showed the specific sources of information you use to determine which of the strategies is most appropriate for the stock that is reporting based on historical data. He gave very specific guidelines as to the use of each and also exit strategies. Goes through and over the material in great detail to show examples of strategies from past performance. One thing that impresses me with each course I've taken is his willingness to repeat explanations if someone asks for clarification. He scheduled the classes for a certain time frame, and because he wants to ensure each participant understands the information, he most often goes over the planned time because he has stopped to answer questions. So that really good summary review from Mary on how it works out. Now we'll go through the enrollment bonuses, then I'll go through the alert service, some of the trade setups we've done recently, so you can get an idea of that. But you're going to get right away the special bonus one will be my on-demand 3-part earnings option course. So this is a course I've done on demand that I did in the past. So you're going to get this that you can start right away with if you want to start working on it this week before we get into the live course next week. And again, it's going to cover all the stuff, a lot of it, but a lot of the new course has a lot of new stuff because of the new screen and more double calendar stuff. But this course will also go into the double calendar, iron butterfly, long condor, iron condor, the short iron condor. Okay, so complete option guide, in-depth explanation of each strategy, how, why, and when to use, trade examples, how to maximize your earnings price spikes using the short iron condor, the right way to sell volatility, long condor and long iron butterfly. So you get that right away, so you get hit the ground running. And so that's one thing I like, if you want to really get ahead of everything. Bonus 2 is you're going to get 30-day trial membership. This is course package 1, but you'll get this for 4 months if you do the alert service. So I have a virtual trading room open each day, opens at 9:30 to 10:30 Eastern, Monday through Friday. Do a daily video newsletter, and I'll tell you what's going on, my view of the market, what trades are coming up, what trades we've done. We do a Q&A every week, usually on Tuesday, live and recorded. Then also you get access to Trader Educational Vault, some additional really good trading information, educational stuff. And again, 60% discounts on everything on my website, courses, software. So if you go to my website, I'll just show you real quick. You'll get, and you use your members code, which we'll give you, then you'll get 60% additional discount on anything that you are interested in. So you look here to the website. So if you want any courses, just come here, trading courses, boot camps, got all of these things in here. So you can then go in, select anything you want, and then you'll get, for example, selling options income course here. If you want to buy this, additional course, come down here, and it's $397, but you put in your members code, which you'll get at 6%, you'll get 6% off of that. Or if you want any software, all my trading software is here, so you'll get 60% off of any of my software. So here's my custom indicators right here. So, if you want the full custom indicator package, $597. Here's another course package price on that, so you'll get 6% off. So, that's additional stuff that you're going to get there. And I always like to point this out. This is from Jay, one of my really, longtime members said, reading books is fine, but seeing the actual option trade setup makes a huge difference. Thanks, Jay. So that's kind of one thing when you come into the trading room, everything pretty much we're doing is based on some kind of option spread, okay? So that's the focus of everything we're doing. We're looking for directional trade setups, and then we're using option spreads to do the trades. All right, so then you're going to get bonus 3, start trading options today. So this is kind of a intermediate option course that you can get started with. So if you're just starting out trading options, it's a great one to add to your trading library. So with this course, it's a very comprehensive, but it goes through the benefits of options versus stocks. What you really need to do or know before you trade options, the option basics, mastering puts and calls. And then you're going to get 3 different strategies in the course: covered calls. I go through that in the course. The protective collar in the course, and vertical debit spread. So you're going to get this as a bonus course as well when you sign up. And then we'll do a follow-up Q&A. This will be the Tuesday after the course, so you'll have be fresh on your mind if you have any questions. And then don't forget, you get the 30-day trial membership to the trading club, or if you do the alert package for the next 4 months. And then you're going to get how the pros use the Greeks. So this is another 60-page option guide with videos on the Greeks, basically delta, gamma, theta, pricing the option, market maker secrets, standard deviation, how to use option delta, trade probability. And then you're going to get my 3 watch lists, which in the course then I'm going to also show you how to set these up for yourself so you can start doing your own scans. But you're going to get these 3 scans, these 3 watch lists when you buy the course here today. So the lists are based on 3 different scans that I like to do. One is for, moves of greater than 5% up or down. The other one is for max 7, max 5. And so you're going to get those screens, updated screens there. Plus in the course, then you'll learn how to do the screen yourself. So here's an example, list 1. This is for list of maximum 5% moves. So you can see J&J, Abbott, things like that. And then it shows you recent close, volume, next earnings, things like that. The other list is max move of 7%. So here are the stocks that were captured doing this screen. And again, in the course, you're going to learn how to do the screen. You're going to learn the resources are used for the screen and how to do it and analyze it. So you can see all the different ones here that it picked up on. And then you can see here's the list 3, another one. This is for greater than 5%. So you can see these are the ones for big price spikes, Spotify, Etsy, things like that, PayPal, Crocs, Datadog, okay? So it shows you when this, after the market, before the market stuff, like that. So you'll get these 3 lists. Now here's the Elite Open to Close Trade Alert Service. So here's from Danny said, you're very diligent and totally thorough with your analysis. That is the foundation of the success in your alerts. I paid for my subscription with the first 4 trades I took with you when I was learning how to trade options. Please feel free to share this with other participants. And then Scott went on to say, it'll be the best investment that you will ever make. Go with the Elite Package, great group of traders in the trading club as well. All right, so with each trade that I send out, again, a lot of members they just want the trades because I select some pretty good ones that I send out, but they'll just do the trade, their own way. But I'll always give you a suggested option trade to use. What is the entry level? When I send out the alert, it'll give you the entry level. I'll give you the option trade. I'll give you the profit targets we're looking for. These are, going to be based on what I call price target analysis, which is unusual option activity, Fibonacci levels, moving averages, things like that. So you get that. What option series to use, stop loss levels and guidelines, trades are listed and archived. Now, when I send out alert, I'm constantly updating the alerts, okay? So if there's something you need to know during the day, I'll send out an alert to give you an update on that specific trade that was sent out. So if there's any profit that you need to take, or if there's an adjustment that needs to be done, or I'll just tell you, it's currently up this amount of money, so you just kind of constantly know what's going on, so you don't have to watch your screen all day. Yeah, you're welcome, Samji. And then we'll do a trade setup video news review that night after the close. I'll also give you that video newsletter, so the review of anything we're doing during the day. We do then a Q&A every week, and those are live and recorded. Then you get the access to my virtual trading room, so 9:30 to 10:30 Eastern every day, and then 6% discounts on all courses and trading software, educational and all. So let's go through a few trades. I'll show you what we've been doing recently. So showed you the earnings trades. We've got 123 closed out, 88 winners, 16 break even, 19 losers. But these are very, very selective trades. I don't send out I'm not constantly bombarding you with the earnings trades. They're very selective. But if you come in the trade room, a lot of times we'll do the trade setup, in the trade room that maybe I don't send out, So also make sure you come to the trade room, because a lot of times members want to say, okay, what do you think about doing this earnings trade? So we'll go through it, and I'll show you, what I would do if you want to do it. So you get a lot of, different things that you can get outside the alert service, just if you do come in the trade room. But here's an update from the butterfly long condors that we've done here recently. We've got really good, performance here. So started this back in 2019 through Friday. We've had 174 trades close out. These are just butterflies or long condors that I've sent out. 122 winners, 13 break even, 39 losers. We're running 78% about win rate. These can be, these are low risk trades, anywhere maybe from $50, $75 per spread risk. Sometimes you get 2 to 1, up to 25 to 1, because some of these butterflies really, really pay off pretty big. And so that's kind of a summary. Here's some, a look at a few that we've done recently. Here's Google. This was a long call condor. And when I send out the trade, you get the alert. It sends out like right here. So this was one we did back on the 24th of June. Google's trading 179.26. And so this was doing a long call condor. So it was long to 180, 182.5, short to 185, 187.5 call condor, max risk. Going into the trade, $72. The max profit was up to 178. So here's kind of what it looks like. It says new Google long trading at 179.50. I'll kind of give you an update on what I'm seeing. So this was a daily cycle low retracement reversal off the 21 EMA. It had a daily and a 4-hour volatility squeeze with positive momentum. So the alert was to buy a condor. All right. So and we were doing this was the 28 June, 180, 82.5, 187.5, 190. So we then adjusted this, tightened the spread up. But anyway, I won't go through all the detail because it'd take too long. But so then on the 24th, we did an adjustment. You can see here we adjusted this to brought down the short strike to 185, 187.5. The 27th of June, I'm sending out constant alert updates. So these are just a few, so you can get kind of an idea of what you're going to see. And here I sent out one. It says currently up around $92 per spread or 127% return. And then here's another one I sent out. Here it was, profit on the close, take profit today was up 171 per spread, 237. So this is the kind of stuff that you'll be seeing through the alerts. And then here's the Google trade, was right here, went long, did an adjustment, profit take, okay? So on the 27th, it was trading 185.41, took some profit. On the 28th, it was trading at 182.29. So here's the risk profile, just what this trade looked like. Going in, doing the condor, we had a risk of 72. Potential to make, if it goes out between the spreads, max profit 178. Okay, so potential to make 178, that would be a 247% return. And this one turned out great. So we had on the 27th, it was trading at 185.41. So the spread was, 72, went to 169. We were at $97 or 135% return. The next day on the 28th, it was now trading at 182.29 right here inside the spread. So it went from 72 to 243. So this was up $171 per spread, close to the max profit of 178, 237% return. Here's another one we did not long ago. This was on net. This was a long, did another call condor. This was set up on the 14th of June. It was trading at 75.40, took profit on the 18th, trading at 79.70. So, you know, another long call condor. We've been doing a lot of these lately. So here's what you would see: weekly cycle low retracement reversal off the 100-day moving average, daily 513 upside cross, positive momentum, do the condor around 52 bucks. And then, you know, here's just more update. I'm just kind of highlighting things really quick for you. And get rid of that pointer. And then here's net. We traded this, so went long right here. These are using my indicators. So you see, just kind of briefly, we had a cycle reversal, positive momentum, moving up here to this kind of moving average resistance. That's kind of why we set the condor up like we did. Here's the trade setup. Doing this as a condor, super low risk. See the risk, 51 bucks. So this was going along the 76, 78 call right here. $2 wide spread, and then at the same time selling against it the 80, 82. Sometimes we'll leg these, but this is doing it all at once. So the spread was set up $51 debit cost. So potential profit spread up with 200 less 51, $149 per spread, potential return 292. And here's where it went out. We got out right here. You know, we get out different. This one was, you know, different exit times and prices at certain points. But here was on the 18th. It was traded at 79.54. So it went from 51 to 124. So it's up $73. But that's a great return, 143% return. Here's another one we did on Meta. So this was on the 5th of June. It was trading at 490. So this was a long call condor. So daily cycle low, retracement reversal off the 21, daily volatility squeeze, positive momentum. So we did this trade here, the 490, 92 and a half, 510, 512 and a half call at around 80. All right, so here's where the setup, and then here's where we got out. So really beautiful trade based on our momentum indicators. So here's the kind of the profile of the trade. So went long the 490, 492 and a half, $2.5 spread with, combining that with the credit spread side, the 510, 512 and a half. So spread width of $250, cost of the trade, risk 65. Potential profit, the difference, 185 or 284% return. And here it was on the 14th, it was trading at 503.94. So the spread flew from 65 to 250. So it was up $185 or 284% return. And here's one I always love to point this one out. This is one we did. This is the penny trade part of the service. So this was one of the first ones that I sent out, but this one really nailed it big time. And this was one that was due on Tesla. So this was set up, it was trading at 189.35, took profit on the 16th into expiration. Now it's trading perfect at 200. So the spread was now up $231 per spread. We had, this was over 1,925% return. So here was the trade setup sent out. It says new Tesla long binary monthly option butterfly penny setup, trading at 189.35. Trade set up for potential monthly expiration pin at 200 next Friday. Buy the butterfly 197 at 200, 202 and a half at around 12 cents, $12. Super low debit cost, right? And then, you know, update here on the 16th, it was trading at $200. Butterfly going out up $215 per spread, 1,791% return. Then I say, wow. This thing is trading into the close. It's going out at 200. Butterfly going out up 230 per spread, over 1,900% return. And that was this butterfly penny trade. So here was where we set the trade up on the 8th, and then it was going out right at our target at 200, you know, into the expiration. So you can see here the trade profile setup. So this was the 197.5. 200, 200, 202 and a half, $12, 12 cents, $12 spread, $250 spread with $12 cost to potential profit to 38 over almost 2,000% return. And this thing pretty much is one of the very few I've seen actually nail it to the penny. So this is where it went out on the 8th. It was trading almost to the penny, which was amazing right there, $200. So it went from $12 to 250 bucks, 1,983% return. So that's the option penny trade selection are part of the service. So we send out a few of those every now and then. Now here's some a couple that we've done recently. Just put these in. This is the counter diagonals. We do a lot of these. So you can see these are, we've done 287 closed out, 210 winners, 15 break even, 62 losers, 78% winning rate, unaudited. And these two here we've done recently. These are pretty cool. Very low risk trade. This was one we did on Starbucks. This was short. We did this, we started out with a put calendar. All right, so when we did this, we started out with what we call a calendar, super low risk. On the 26th, it was trading at 78.67. Then what we ended up doing, we just recently were able to adjust this to a put butterfly with zero risk. Okay, so this is what we ended up doing. I just put this in there, so I haven't had time to really finish updating this like I like it. But here it says new SPX Starbucks short. It was trading when we sent this out. The 26th was trading 78.67. Daily cycle high retracement reversal. Daily negative momentum 513 cross. So it says buy a calendar. So we did this when we initially set it up for 52 bucks risk. Okay, then on the 28th, we adjusted it to a calendar. We adjusted the short strike, so we still added on, did another adjustment. Then on the 1st, we adjusted this to a put butterfly right here. So it was trading now, it was trading when we set it up was 78.67. Now it's trading down to 77. We were able to adjust this to a free trade where that means we have no risk. So we ended up with a put butterfly, adjusted this to a put butterfly in that 12 July series of 77, 75, 73. All right, and then here was Friday the 5th. The adjusted short butterfly now is trading at 75.45, pretty close to our target. And so this trade was up. I sent out an alert to tell you it's up $75 per spread. So, make sure to take some profit, but this has potential for even bigger profit if we were to get a pin next week. So here's the trade setup. We set this up on the 26th. It was trading right here. We set it up initially as a calendar targeting 77. We did an adjustment right here, adjusted to a butterfly, targeting 75 down here. And then yesterday, going out, it was trading at 75.47. This was up $78 per spread on zero risk. So basically a free trade. The way we were able to do this by structuring it into the butterfly for the 12 July series, we recouped all of our costs and we had no risk. Now this is where the actual spread though went out yesterday. Some members just kept it as a spread. So on the 5th, we had adjusted this to the 77, 76 put counter diagonal with a look at the adjusted price, $32. Yesterday, this went out at $142 on this put counter diagonal. So this was up $110 per spread, 343% return. All right, but we'd also adjusted it to the butterfly. So some members just, I saw they just stayed in it for where it was with the put calendar. But what we did was the adjustment was here. We did this adjustment on the, I think we did this on the 3rd. And so we adjusted this to a put butterfly. So see, we're long the 12 July 77 put. So we were able to close out the other part of the spread and adjust this to a 12 July 77 put long, short the 75 put, sold the 75 put, bought the 73 put. We adjust this to an $8 credit, zero risk. spread width 200 plus a credit of 8. So this has potential. If we were to get it to go out next week at 75, this would be at $208 per spread on zero risk. This went out at 78 on Friday. So I'm not sure if we'll get it at 75. It might bounce, but we can stay with the trade. We have no risk. So we have a great edge. So we can just kind of let this thing play out a little bit. So here's where it was on Friday. You can see we had this trade. Here it was, $8 credit actually. Here's the spread. So it went out right here. It was trading right about there, 75.47. So this went from $8 credit. It was trading at $70, the debit spread, plus 8 the credit. So up $78 per spread on zero risk. So that was one we just recently did, and we're still in it. Now here's another one that we just recently did on the 27th. We're still in this one as well. This was on Airbnb. And so it was trading at 151.29, and then we did an adjustment on the second. We converted this to a free trade too, a long call condor. Okay, and then yesterday it was trading at 152.50. It was up $83 per spread on zero risk. So here's just kind of when we set the trade up on the 27th, and it was trading at 151.29. Daily volatility squeeze, positive momentum, 4-hour squeeze just triggered. Here, the initial trade was buying the 12 July, 152, selling the 5 July, 155 call at around $2. Okay, and then on the second, we did an adjustment, and we, you can see here it was trading at 152, it was trading around 155.55, and I sent out an alert, say if you're long the 152 and blah, blah, blah. If long multiple contracts, take some profit. At that time, it was up 86. And then we did the adjustment right here, where we adjusted it on the second to the long call condor, and we're able to do it for zero risk. We actually got a credit, all right? So this is what I'm constantly, looking for, trying to get these adjustments when we see the opportunity. So we set it up here, and then we did the adjustment right here, actually right here. And then yesterday it was going out right there. And so then here's where we were with the adjustment. So we ended up the adjustment on the second. It's trading at 155. So we now ended up long the 152.5 call, short the 155, $2.50 wide. Shorted the 157.5 against it, the 160 call credit spread here. So we had this spread, $2.50 wide. We were able to do this for a credit of $6. So zero risk, we actually had a credit. All right, so you can see here, if it goes out, I'll show you, within our call condor, then we're gonna potential profits $256. So this one we can just kick back. We don't have to really do anything. And so then yesterday, here it was trading, towards the close, it was trading at 152.50. All right, so it was down, it had gone down, but it was still, the spread was up $83 per spread here. So, we had it on adjusted for a credit, so no risk. If it goes to the upside, outside of our wings, we make $6. So it goes to the downside, we make $6. But if it goes out in between here, we've got the potential to make that $256. If it goes out of here, we can make potential $256. And this was up 83. So we still have a big potential profit into this trade into next week. So that's pretty much everything. Any questions, please feel free, and make sure, let me see here. You're welcome. Yeah, thank you, Audrey. Let me see if I've missed any questions here. The course next Saturday will be from 11 to 2, so it's 3 hours, and it's recorded. So if you can't, sit through the whole thing, that's all recorded, and then we'll finish up on Monday from 4 p.m. to 5 p.m. Eastern. Yeah, GLD looks good. I like it. All right. All right. And you're welcome. Yeah, I'm happy to share my time and knowledge with you guys and gals. So again, here, just use that link one more time. Right there. And here's everything you're going to get on course package 1. And then if you do course package 2, you get, all 5 of the alert services, whatever comes up that I like, I'll send those out. And then you get everything in course package 1 plus the alert services. Okay, yeah, Donna, I will make sure that you can get those indicators. Yeah, I will definitely I'll get my assistant Rachel to contact you. Does that sound good? You're welcome. All right, so that's everything. And look forward to seeing everybody next Saturday. So next Saturday, the 13th of July, 11 a.m. to 2 p.m. Eastern. Then we'll finish up, or however long it takes, but I try to stay around this time frame. And then we'll finish up on Monday, 4 p.m. to 5 p.m. And then we'll do the follow-up Q&A the next day. So you'll have fresh on your mind if you need any questions answered, anything like that. All right, any last questions? If not, we will call it a day.